Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. I've been taking a look at returns. Now, I'm not talking about the stuff that you got for Christmas and then you took it back to the store. I'm not talking about those kinds of returns. I'm talking about returns with regards to investing your hard-earned money. I mean, what kind of returns are you getting in the markets today? Well, I guess it depends on where you go for your information. I mean, I've seen stuff out there saying the returns have been like super awesome, incredible in the stock market because the stock market has been going up and to the right. And then I've seen some other stuff that kind of makes me scratch my head and go, where did they get those numbers from? Because those numbers seemed like really low to me. But the consensus that I see indicates that the stock market has been returning somewhere between like 8 and 10%. You know, there's a website called wealthsimple.com, and they just did an analysis of what the S&P index returned, and they looked at it from a long period of time. I mean, from 1957 to 2018. That's literally a lifetime. And when you think about that, that is similar to a working lifetime. Now think about it. If you started investing in 1957 and let's say you retired in the year 2000, and then you're living off of the investments that you made, say for a 20-year period of time, you were looking at 7.96% return based on the S&P during that time period. So, I mean, that's literally a lifetime of working and potentially retiring and trying to live off that money. And depending on how inflation affected that money, you may or may not have had enough money to retire by the year 2000. You remember Y2K. Maybe you had to work a little bit longer. I don't know. Trust me, I wasn't born in 1957. I wasn't born until 1964. So people that started working in 1957 are a bit older than I am. I mean, I would say that those folks are, probably in their late retirement years. They're probably in their 70s, maybe their 80s. And the reason I bring this up is because I think you need to understand that real estate is a better vehicle for you to get yourself to a point of retirement. I really do. And I believe firmly that when you invest your money correctly into real estate assets, those assets will pay you 5 different ways. Technically 6 different ways if you're talking about pure multifamily properties. Those are properties that are 5 units or more. So what I did was I took a look at what some investments that were made available to me back in December. I went back about 60 days, and I looked at some of the information that I had received from real estate agents that I have relationships with, who sent me deals to analyze and determine whether or not these properties would make sense for my portfolio. Now, at the time they sent me these particular properties, I was actually buying other stuff. So these properties didn't quite get past my radar. In other words, they showed up, they notified me that, hey, these things are available. If you're interested, let me know. And basically I said, I'm not in buying mode right now, so don't hold that property for me. But I decided to go back and analyze these properties because 2 months, literally 60 days, is the normal life cycle of a Lifestyles Unlimited member when they identify a property, when they buy the property, when they rehab the property, when they find the great resident for that property, and they put that property into stabilization with long-term financing, and that property starts producing income streams for them. And the biggest one of all is cash flow, because it's with that cash flow that you're able to start offsetting your ordinary expenses of life. I know I say this time and time again on the show, but I think you need to understand that there's a better way to get to retirement, and real estate has all the functionality that you need in order to achieve retirement in 5 years or less, rather than, putting your money into a mutual fund or the S&P 500 or wherever you're putting your money and getting an 8 to 10% return on your money. So let's talk a little bit about some of these deals. Now, the first deal that came to me was a property that was a 3-bedroom, 2-bath, 2-car garage. It was built in 1958, is 1,236 square feet, according to the information that was sent to me. And this property is located in the greater Houston area. Now, the property went on the market for $102,000. In other words, I had the ability to buy this property for $102,000. Now, the broker's opinion of value, in other words, what that property would be worth in that particular neighborhood where it exists, all fixed up, is $170,000. So there's like $68,000 worth of potential equity sitting there. Now, I'm going to have to fix the property up, so I'm not going to grab $68,000 worth of equity. But I can utilize that equity to keep my cash outlays to a minimum on this property. As a matter of fact, the broker's opinion of value indicated to me that I could receive approximately $500 a month in positive cash flow for about a $28,000 investment. And we're going to get into that after the break.
Warning. Listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. So we're going to talk about a property that came on the market last December. And you're probably thinking, why are we going back in time a couple of months to a property that may not even be on the market anymore? Well, the reason we're doing it is to illustrate a couple of points. The first point is that opportunity comes and goes. The opportunity to change the path that you're on shows up literally every day. And by going back 2 months and looking at a couple of deals that I personally passed up because I was buying other pieces of property, I did not have the available cash to buy these properties at the time, nor did I have the desire to buy any additional single-family properties at the time because I was working on something else. And that's okay. That's totally okay. That just means that if I'm not in the marketplace for a particular asset, that asset is available to somebody else. And I'm totally fine with that. I actually like the fact that I get to look at properties and analyze properties, even if I'm not necessarily in a buying mode, because what it does for me is it gives me a sense of how properties are trending. It really does. It gives me an idea of, what properties are doing in the form of cash flow. How are properties doing in the form of valuation? How are property, the stuff that I find interesting with regards to investing in properties. So this particular property that came on the market was available for purchase. I could buy it for $102,000. The after repair value of this property, in other words, all fixed up, properties in that particular neighborhood were selling on average for about $170,000. So there's a net equity of about $68,000 there that I can work with. Now, this particular property, it needed a lot of work. And when I did the calculations to determine, what I thought the repairs might be on this particular property, based on the age, based on certain conditions that were disclosed to me, I came up with a number of around $43,750. Now, some folks would think, all right, let's see, $102,000 to buy it, plus $43,750 to rehab it, plus closing costs. Oh my gosh, you're talking about a lot of money. And yeah, you are talking about a lot of money if you were to pay all cash. Now, that's not the way we do it at Lifestyles Unlimited. We do it a slightly different way. Some people would think, well, yeah, there is a different way. You use leverage. I mean, we talk about leverage on the show, right? So what that means to some people is that they'll take out a loan. They'll find a conventional lender, and there are conventional lenders out there that will loan you on distressed property. But they're only going to loan you based on the current value of that property. In other words, they're not interested in loaning you any money to fix that property up. So how that would pan out is like this. You would come to the closing table with about $20,400, which is 20% of the current value of that property, that $102,000 price. And then you have to come to the closing table with about $43,000 because that was the repair estimate that I came up with. And you're going to have closing and holding costs of, maybe another $5,000 to do the deal. So all in, you're going to come out of pocket just north of $69,000. Again, that's a lot of money to do this particular type of deal. At Lifestyles Unlimited, we teach a completely different methodology. We believe that you get the best returns by putting the least amount of your own money to work in a particular asset. And because you are educated on how to invest correctly by Lifestyles Unlimited when you're a member, we have vendors that are a part of our vendor program, which is available to every member of Lifestyles Unlimited, that understand that we meet the acid test for what a sophisticated investor is. Now, a sophisticated investor is somebody who's been properly educated on how to invest in property. Now, there's also something called an accredited investor, which has to do with income streams and net worth and things like that. That's kind of a different level. I'm not worried about that. But because you become a sophisticated investor, because you know how to invest correctly, what you're able to do is to acquire this property for a lot less cash out of pocket than that $69,000 number I just referenced. So what number am I talking about? How about $28,250? Yeah. See, what you're able to do is you're able to go out and based on the after repair value of a particular property, there are hard money lenders out there that will loan you up to 70% of that after repair value. So what that does is it gives you a pool of money that you can use to acquire the property and also to make some or all of the renovations on a particular property. Now, this particular property, it's going to need a lot of renovations. The 70% number doesn't cover all the costs. And as a result of that, yes, you do need to come in with, say, $28,250 cash out of pocket to do this deal. But when the dust all settles, there's a couple of things that have already occurred. First of all, when the property is fixed up and you obtain an appraisal for $170,000, you don't have $170,000 into the deal. You've actually captured equity in this property of approximately $14,250. So what that means is that's equity in the property that's available to you should you decide to sell the property in a year and the property doesn't even go up in value. It's wealth that you acquire. And that's just one piece of the puzzle. There are other pieces of the puzzle. You see, the rents that this property can command, when you calculate what the rents are doing in that particular neighborhood and you subtract your expenses for operating that property, your cash flows analysis comes out to $507 per month. That is a $6,084 a year increase in cash flows into your household. And when you have that $6,000 a year coming into your household, you've effectively given yourself a $6,000 raise. Now, let's talk about the returns, because now you're looking at a 22% return on your money. That's pretty cool stuff. When we come back from the break, I've got more info to share. Stick around.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. So we're talking about a property that I actually passed up on in December. And the reason I'm bringing that to light today is because I want you to learn from what that property had with regards to the potential to provide to you. So had I purchased this particular property that I was looking at, it was a 3-bedroom, 2-bath, 2-car garage, 1,236 square foot home, built in 1958, had a lot of deferred maintenance on it. What I do know is the condition of the property, and it was not in very good shape. But the other thing that I knew was that properties in that particular subdivision were trading for around $170,000. So I felt really comfortable that if I acquired this property, if I had fixed this property up, if I had found a great resident to live in that property, I would do pretty well. And what I'm doing is going over some of the numbers. So let me just restate a couple of things, because we're talking a lot of math today, and sometimes I know that can hurt your head. Sometimes it hurts my head. So what I'm getting at is this. This particular property, because it was, well, kind of abused, could be bought for a price of $102,000. But all fixed up, it would be worth $170,000. So one of the things you need to figure out is, okay, what's it going to take to fix this property up? And because I've gone through the Lifestyles Unlimited Real Estate Investor Educational Programs, it's pretty easy for me to figure those numbers out. I came up with a number of $43,750 to do the rehab on the property. So with that all-in cost, I was looking at about $145,750 if I were to pay all cash to do this deal. Now, if I did the deal, I wouldn't do all cash. What I would do is I would leverage other people's money in the form of hard money assets. In other words, I would work with one of our Lifestyles Unlimited vendors that was specialized in lending hard money. In other words, hard money is an asset-based loan that is designed. Wow, did you hear that, Thunder? It's an asset-based loan that is designed to loan you a set amount against the future value of the property. And because those particular lenders understand that I am at least a sophisticated investor. In other words, I know exactly how to go about doing this. And because I have mentors to help me, and I've just have surrounded myself with like-minded individuals that are also members of Lifestyles Unlimited, I can get this done. So when you use a hard money loan, you are able to acquire the property and pay for a portion, if not all, of the repair costs on this particular deal. So what I was looking at was the hard money lender would loan me $119,000. That's essentially 70% of the after repair value of $170,000. So with that $119,000, I'll buy the property, I'll close escrow on the property, and then I'll still have some money available to me, about, somewhere in the neighborhood of, 12 grand, whatever the number is, to do repairs. Now, I'm going to have to come into the deal with additional money because this property is going to require a lot of repairs. But when all is said and done, and I have renovated the property, I have put a quality resident into that property because really I've got the nicest property in the marketplace. And trust me, if you've rented property before, you know that depending on whatever your price point is, you're going to see everything from the good to the bad to the ugly. And I definitely don't want my properties to be in the bad or the ugly category. I want them to be in the good and on the good side of good category. So what happens is you have people that are willing to compete for your property so you can be a little bit more selective. Now, you have to follow all fair housing laws. You are not allowed to discriminate against anybody based on, we teach you all those things, but, age, sex, marital status, I'm not even going to get into all of them. But you have to treat people fairly and equitably. But you can be selective with regards to who moves into the property. Now, once that resident moves into the property and you've got a lease signed, now you go to another Lifestyles Unlimited vendor who's a conventional lender. And by the way, a lot of the vendors that we have in the hard money space and in the conventional space, they have relationships with each other, which makes this so much easier to do. So you'll put your long-term financing, which will cure that hard money loan. That hard money loan's going to go away. Maybe you made one payment. Maybe you didn't make any payments at all. Okay? The hard money loan goes away. The conventional financing goes into place. And now you have a stabilized property with a 1-year lease on it and a great resident in that property that is paying you rent on the first of the month because that's what you stipulate in the lease. And then, of course, in the lease, there are penalties if you fail to pay on the first day of the month. Yeah, it's all outlined in your lease, and you decide what is appropriate for you and your resident. So in this particular property that I'm describing to you, when the dust all settles and my total cash out of pocket to do this deal is $28,250, I'm receiving positive cash flow every month that resident is in the property of $507. That's based on the rents that you can command in that particular area, minus, essentially your mortgage payment, which is your principal, interest, taxes, and insurance. Because you fixed everything up that could go wrong, you're probably not going to have any maintenance costs. And because you've got a great tenant in that property in a 1-year lease, you're probably not looking at vacancy rates. So I'm looking at positive cash flow of $507 a month when the dust all settles. What that creates for me is an income stream of $6,084. Now, when I started the show, I told you I was looking on the internet to see, what's the stock market been doing? And historical gains have been 7 to 10%, depending on how you invest and things like that. Well, one particular property has the ability to more than double that. And that's just in the form of the cash flow. Now, here's the other interesting thing. If you invested that $28,250 in the stock market, at the end of the year, if you made 10%, you'd have $2,825. But at the end of the year, I have $6,084. I have more money coming to me based on the fact I invested in this real estate. Now, that $2,825 that you made in the stock market, that's subject to taxes, however you get taxed, okay? But because you take depreciation expenses, and on this particular property, you're going to take a depreciation expense of $6,182 per year, your tax liability is a negative 98.
We're back with the Lifestyles Unlimited Real Estate Investor Radio Show. We're here to answer your questions and help you become financially free.
Welcome back to the show. So we're talking about the returns that you can get in real estate with regards to the returns that you can get in the stock market. Now, historically, the stock market has been producing returns in the neighborhood of 8 to 10%. That's based on information that I've been able to find while searching the internet. And there's a lot of sources that indicate that that's about what they do. But when you invest in real estate, your money works more efficiently for you. And I really don't understand why you would want to continue to invest in the stock market when real estate has so much more potential for you. It kind of puzzles me. And well, maybe it's because nobody's bothered to explain any of this stuff to you. Because you think about it, most of us have been told at an early age that the way to obtain financial freedom is to take some of your hard-earned money, maybe put it into a 401k, IRAs, SEPs, whatever you're using, and to invest that money in the stock market. Maybe it's in mutual funds. Maybe you buy individual stocks. I don't know what you do in the stock market, but I know a lot of you have your money in the stock market. So what if you took $28,250 out of your stock fund and you're thinking, wow, I don't know, man, that sounds risky. I don't think it is, though. I really don't think it is. Because if you invested that $28,250 in the stock market at a 10% return, you would, at the end of the year, get $2,825. Yeah, and you really don't have to do a whole lot to do that, right? But when you invest in real estate, you're going to get better returns. Now, every real estate deal is different. So what I'm telling you with regards to the numbers today are in regards to numbers that existed in December. And the reason I went back to December and looked at some of the deals that were available to me at that time period is that I knew that great deals were coming onto the market because I watch the market. I have cultivated relationships with people that send me deals on a daily basis. And I look at those deals, I analyze those deals, whether I'm going to invest or not. It keeps me sharp with what's going on in the marketplace. And I don't spend a whole lot of time doing it. I probably spend as much time doing that as you do watching your stocks go up and down. Yeah. And I probably spend less time, to be honest with you. So when I say these deals, there were actually two deals that came across my desk. And they were very similar. In other words, one deal you could buy for less money, but it was going to cost more money to do the rehab. And it was more of a major rehab. It's not the kind of rehab you want to do on your first deal. I mean, this second property was really beat up. And it was in a different neighborhood, but like the first deal, it had an after repair value of $170,000. So all fixed up, that's what that property was worth. And the second deal actually had a slightly higher net equity that you would capture by doing this deal. When you compare the rents, the cash flows, the property I've been describing to you was returning $507 a month, or 22% return on your money, annualized. The second deal was returning a little bit more cash flow, but because you had to put a little bit more money into the deal, you were getting a 23% return on your money, which is still better than what you are potentially getting in the stock market. Now, let's go back to that original deal, and let's talk about what happens over time. Because over time, you have the ability to increase the rents. You can make a decision that after the first year, you're going to raise rents maybe $20 or $25 or whatever you think is appropriate for that marketplace. Or maybe you choose not to raise rents. But if you choose to raise rents, that's going to have a benefit on your cash flows. Now, some of your expenses may go up. Maybe taxes went up. So maybe that's the reason why you're going to raise rents to offset the cost of taxes. It's a business decision. But let's just say everything stayed the same. Let's pretend like we're in economics class and everything stays constant. When you receive your $6,084 per year in annual cash, let's just call it $6,000. Let's make it simple. You're allowed to take depreciation on this property. In other words, the IRS says that property will wear out over time. So they basically say you take the value of the property, you divide it by 27 and a half years, or 27 and a half. So you take the $170,000 value, you divide it by 27 and a half, and that's going to give you an annual depreciation number. Now that depreciation number comes out to be $6,182. When you subtract $6,182 from the $6,084 you received in rental income, you actually have a tax liability of a negative $98. Or in other words, you don't have a tax liability on the incomes that you received on that particular property because depreciation is offsetting it. Yeah. Now, if you had taken the $28,250 that we talked about, went into this deal, and you kept it in the stock market, you would make less money and you would have a tax liability on that money. It's just the way it works. Now, over time, this property has the potential to go up in value. Based on all the studies we have done, we have determined that real estate has a ability to double in value approximately every 20 years. Sometimes it's faster in some places, sometimes it's slower in other places, but the sweet spot seems to be 20 years. So what I like to do is I like to take a look at appreciation, and I use a number of 3.5% because that's a number that works well for me for the areas that I invest in. So if you hold this property for 3 years, not only are you going to, and assuming you don't change your rents, everything stays the same over a 3-year period of time, you're going to have an income stream of $18,000. You're still going to get that 22% return on your money, but that property is going to go up in value. And I estimate it going up in value approximately $18,500. So you're also kind of getting a 22% increase just on appreciation. So you've got money sitting in that property. So at the end of 3 years, you're looking at a projected future value of this property going from $170,000 to approximately $188,500. You now have additional equities in this property. Now, along the way, when your resident was paying you their monthly rent and you were turning around and making your mortgage payment, you were paying down that mortgage because a portion of that payment goes to principal, a portion of that payment goes to interest. You get to write the interest expense off, and the principal declines over time. So over a 3-year period, a $136,000 loan, which is 80% of that original $170,000 valuation, is going to pay down approximately $6,900. So your loan balance is going to be right in the neighborhood of $129,100. Now, let's say you decide at the end of 3 years you're either going to sell or refinance. If you decide to sell the property, you're going to have a net equity of just about $59,000 in this property. And when you subtract costs of sale, I like to use an 8% number of about, that turns out to be about $15,000. Your adjusted capital gains in this property is $48,303. So you think about it. You put $28,250 into this property. It's been returning cash-on-cash returns of 22% over a 3-year period. You've got valuation increases of about $18,500. And then when you go to sell this property, you're putting approximately $44,300 into your pocket. Kind of neat. And what do you do with that money? Well, you potentially go out and buy 2 more properties. That's kind of the way it works. Or maybe you decide you really like this property. You think it has potential to go up in value because that's whatever you're looking at in 3 years from now is telling you that that's the way to go. Maybe you want to hold it another 2 years, but you want to take some money out. Your projected future value at 3 years is $188,500. If you take an 80% loan out of about $151,000, you're going to have over $21,000 of money coming to you that's tax-free. Just a different way to look at it. So if you want to find out how we do this stuff, how this stuff actually makes sense, go to freeworkshoplivestream.com. And remember, it's not the money, it's the lifestyle.
The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.